When we talk about the AI revolution, there's one name that just dominates the conversation, right? The company building the engine for this whole new world. But what if the real, lasting opportunity isn't in the shiny engine itself, but in the fuel it desperately needs to run? Today, we're going to look past the hype to find the real, physical foundation of our digital future.
And hey, it makes sense. The AI gold rush has made the main hardware supplier, NVIDIA, an absolute giant. Their chips are the picks and shovels that literally everyone needs to dig for AI gold. I mean, their stock has just been on a tear. But in any gold rush, the most reliable money isn't always made by selling tools to the miners.
And this is the core idea. The entire digital revolution, all that amazing software, every incredible model, every single GPU, it all comes to a screeching halt without this one massive, physical, and honestly pretty overlooked industry. It's a business of atoms, not just bits.
So here's our game plan for today. First, we're going to look at the NVIDIA frenzy just to get a sense of the scale here. Then we'll uncover AI's massive and kind of hidden thirst for power. After that, we'll explore the unbreakable monopoly that's cashing in on this, how you can invest in it, and finally, we'll do a reality check, comparing this fortress approach to the rocket ship tech stocks we all know.
Okay, first up, let's set the stage and really wrap our heads around the sheer scale of excitement around the king of AI chips.
$3.34 trillion. Just let that number sink in. That is an absolutely staggering valuation that shows you just how much confidence investors have. It's the number that perfectly captures the peak of this AI hype.
But here's the catch, right? A valuation that high means the stock is basically priced for perfection. For NVIDIA to just keep up with the market from this point on, forget about beating it, it can't just grow. Analysis shows it has to grow its earnings more than 7 times over. That is an incredibly high bar, and it leaves almost zero room for error.
So while the market is completely obsessed with the digital side of things, there's a physical reality that we just can't ignore. And this reveals the real bottleneck in the entire AI revolution.
The biggest myth in this whole space is that AI is just a software game. But the reality, it's a business of atoms. Success is completely dependent on physical things, building gigantic data centers, getting enough water to cool them, and, the big one, getting access to power, gigawatts of it.
Let's put some real numbers on this. OpenAI, just one company, is planning for up to 26 gigawatts of new data center capacity. Now, to put that in perspective, 1 gigawatt is what a nuclear power plant puts out. It can power almost 900,000 homes. OpenAI wants to use the equivalent of 26 nuclear power plants.
And remember, that's just one company. By 2030, the total power demand for AI data centers is expected to hit 156 gigawatts. Now, this creates a really fascinating and pretty dangerous risk of what's called stranded capital. That's where companies spend billions on these amazing chips that they literally cannot plug into the wall.
And the amount of money needed for this, it's just mind-boggling. McKinsey estimates that nearly $7 trillion in capital will be needed in just the next 5 years to build out the infrastructure for this demand. To give you some context, that's like the AI industry alone spending about a fifth of what America's entire economy spends on capital projects.
And here is the central issue, the real problem. Building a power grid is a slow, tedious process. Just getting through the regulations can take 5 years. Building the thing can take another 5, maybe more. AI companies, they operate on internet time. They want it yesterday. But the power grid, it operates on infrastructure time. And that mismatch creates a huge, long-term bottleneck.
So if power is the bottleneck, who controls it? Who owns that choke point? Well, this brings us to the really unique and powerful business model of the companies that own the wires.
These companies are what we call regulated monopolies. Basically, they're given exclusive rights to provide an essential service, like electricity, in a certain area. In exchange, the government looks over their shoulder and regulates the prices they can charge. This ensures they make a fair profit on what they build, but not a crazy one.
Now, this kind of business is built like a fortress for 2 really simple reasons. First, the barriers to entry are just massive. It takes a ton of money and years of navigating red tape to build new power lines. Second, there are no substitutes. I mean, think about it. Whether your power comes from solar, wind, or a nuclear plant, it doesn't matter. It all has to travel across the grid to get to you.
This kind of business, with the huge barriers to entry and no competition, this is exactly what Warren Buffett will call a wonderful company. It's kind of like owning the only toll bridge into a booming gold rush town.
You might not have the explosive growth of finding a gold nugget, but you have this durable, predictable business that just collects a toll from absolutely everyone who wants to get in.
Okay, so this all sounds pretty compelling, right? But how do you actually invest in this critical infrastructure build-out? Let's get into the blueprint.
You've basically got two main paths here. You can buy equity, that's stocks, which makes you a part owner of the utility company, or you can buy their debt, which are bonds, and that makes you a lender to them. And this is where that phrase infrastructure debt supercycle comes from. To fund the trillions of dollars we just talked about, these companies have to borrow huge amounts of money by selling bonds. When you buy these bonds, you're essentially financing the AI revolution at its most fundamental level, and you're doing it with a much lower risk profile.
Now, for anyone who prefers a more diversified approach, you can look at ETFs. Sure, a broad tech fund like VGT gives you the big AI names, but there are also specific power infrastructure ETFs like Power, or the Utilities Select Sector SPDR, that's ticker XLU. And it's not just utilities. You can also look at other picks and shovels companies that support the physical stuff, like thermal management and networking gear.
All right, before we get too carried away, we need a serious reality check. It is absolutely critical to understand what kind of investment this is and what it isn't.
Think of it like this. Tech and AI stocks are rocket ships. The goal is rapid, explosive 100+% growth. They're super exciting, but they're also super volatile. Utilities are the exact opposite. They are fortresses. They're built for stability, for income, for preserving your capital. They are slow-moving, predictable, and defensive. It's the difference between betting on one specific miner striking it rich versus owning the unbreachable toll booth on the only road into town.
And let's be brutally honest for a second. If you're looking for 100% gains in a year, this is not where you're going to find it. Utilities are just not huge movers. But their boring nature isn't a bug, it's a feature. They are designed, by their very structure, for stability and predictable returns, and that can be a really powerful part of a balanced portfolio.
So as we wrap this up, here's the big question to think about. In this new era, as AI starts to literally consume the power of entire nations, who's going to profit more in the long run? The brilliant minds creating these incredible, power-hungry digital worlds, or the quiet, unbreakable monopolies that own the physical grid that every single one of them depends on? The answer to that is going to define the next great supercycle of investment.